So, welcome to Chapter 3. I hope before we start that you've got your PowerPoints, or excuse me, your handouts printed out because we're going to start actually writing out journal entries here. And this is something that you're really going to want to practice by hand. It helps those fingers to grow the more that you write these down and again, practice them, actually engage with the content. So, we're going to start off by looking at the beginning of the accounting cycle. So an accounting cycle is whatever normal procedures we take over a period of time. Usually this is 1 year. So we can either use a calendar year, so January 1 to December 31, or we can use what's called a fiscal year. A fiscal year is any 12-month period. So a lot of times companies will start their accounting year in the first month that they start operations. So if you started in August, then your fiscal year may go August 1 to July 31. It may also coincide with kind of your with what your regular year is. So a lot of schools go September 1 through August 31, or a lot of companies that do a lot of government contracts go September 1 through August 31 because the governmental year runs September through August. So it just kind of depends on your business, but either way, we're going to primarily assume a calendar year because we're used to thinking of December 31 as being a year end. But if that's not your year end, then, just make that adjustment. So we do reports either annually, certainly. Quarterly is another common way to do reports. In fact, if we're a publicly traded corporation, we're required to submit quarterly reports to the SEC. But then we may also choose to do monthly reports. So whatever period of time, this is the same period of time that your income statement and your statement of owner's equity will cover. So when we're doing a journal entry, the general journal is where we start. This is called the Book of Original Entry. Now there are special journals, so when we say general journal, that's an actual title. It's the general one that most of the stuff will get covered in. It just lists everything that happened. We're going to list all of our transactions. So those transactions that we learned to analyze in Chapter 2, we're going to write them out in kind of a semi-sentence format here in the general journal. We're going to list them in chronological or date order. And then once we've got them in the journal, we will transfer them, or post them is the actual verb that we use here. We say we post them to the ledger. So we talked about the chart of account in Chapter 2. Remember, this is just a list of all the accounts that our company uses and what preferred names that we use. So we've switched companies here. We're now going to be Rob Sinclair's Highlight Graphic Services Company. And so we can see, for example, they choose to use graphic design fees as their revenue account. They have office salary expense as one of their accounts. So just some of our common accounts that we see and what specifically Rob Sinclair is choosing to use as names. So when we journalize a transaction, there's several steps. I'm going to walk you through the steps here, then we'll look at an example. First of all, every transaction, as we learned in Chapter 2, has at least 2 accounts affected, and at least one of those accounts will be debited and one will be credited. So we always have at least one debit, at least one credit. And remember that the sum of the debits has to equal the sum of the credits. So when we're writing a journal entry, the account that is to be debited is recorded first. If there's multiple accounts to be debited, then we list all the accounts to be debited first, and then all the accounts that are credited are listed second, and they are indented a little bit. Now, the explanation is kind of like the memo line of a check. You can write that down there. It is technically optional, although my accounting lab will make you put the explanation there, and it's always a good account to be a good habit to get into. But the cardinal rule of accounting, remember, is that the total debits must equal the total credits. So you want to star, highlight, triple underline that in your notes. That's super, super important. So let's look at an example. So we're told on May 1st, Rob Sinclair began their business and he invested $10,000 in cash. So let's think about this. What 2 accounts are affected here? If you said cash and capital, you would be correct. So I like to start with cash whenever cash is involved. So I'm just going to write aid reveille up here at the top to refresh my memory. So cash is an asset. Assets have a normal debit balance. That means they get increased on the debit side and decreased on the credit side. Remember, we are looking at this from the perspective of the business. So in this example, the business received $10,000 in cash. So that means we need to increase the asset. So we would debit the cash account. So if we're debiting cash, then by default, capital has to be credited. But remember, the O in aid reveille is capital and retained earnings. And so we said that capital is the amount of investment. And since there's been more investment now than there was before, we need to increase the capital account, and that gets increased with a credit. So remember, we're debiting cash, we're going to credit capital for $10,000. So let's look at our entry now. So here are the parts of our entry. First of all, we always start with a date. So this was May 1st. You can see that the cash account is listed first and it's left aligned. So that is the account that we are debiting. And then Rob Sinclair Capital is listed second. And notice that it is indented here. There's a space. We've tabbed over. So we've indented Rob Sinclair Capital. Notice the columns. So the first column of amounts is the debits, and we've put 10,000 there. And the second column of accounts is the credits, and we've put 10,000 there. So our debits equal our credits, and they're in the proper columns. And then we have our brief explanation, initial investment of cash by the owner, that we've just listed underneath our last credit. So let's do another one here. And again, I hope as we start going through these, you'll start pausing the video. You'll try to do the journal entry on your own in your notes, and then you'll restart the video and check your answers and listen to the explanation. So we, the company, purchased computer equipment from Giga Company for $6,000. We put $1,000 down, we paid $1,000 down, and then we promised to pay the rest within 30 days. So let's ask ourselves, what accounts are affected here? And I'll give you a hint. There's 3 in this example. So computer equipment is affected, cash is affected, and then we would have accounts payable. This promise to pay would be accounts payable. So again, let's go up here and review aid reveille. So computer equipment is an asset. I have more computer equipment now than I did before, so I need to increase the asset computer equipment. Assets have a normal debit balance, so I want to debit computer equipment. Cash is also an asset. In this example, cash went down because I paid $1,000. So that means I want to do the opposite of the normal balance, or I want to credit cash. Now, I'm only crediting cash for $1,000, but remember I bought equipment for $6,000, so I've got a debit to equipment for $6,000, a credit to cash for $1,000. That means I need another credit to balance this out, so that credit would be to accounts payable. Accounts payable is a liability. Liabilities have a normal credit balance. I have more debt now than I did before, so I want to credit accounts payable. So let's look at our example here. Again, we've put our date. Now notice we didn't repeat the month because we listed that on the first one, but we put the date here. I've got a debit to computer equipment of $6,000. I've got 2 credits now, so this is again what we call a compound entry. So both of them are indented. I've got a credit to cash for $1,000 and a credit to accounts payable, my debt that I have to pay in 30 days, for $5,000. So the total of my credits equals the total of my debits. And then I've got my brief explanation there. Now, it doesn't matter what order you list your credits in. If you listed accounts payable first and then cash, that is perfectly acceptable. As long as all of the credits come after all of the debits, that's all that we really care about. So again, I said this was a compound journal entry because it has more than 2 accounts. All right, let's try another one. So go ahead and pause the video here and then come back and check your answer. So here we're told we rented office space. We paid $1,200 in advance for the first 3 months. So we haven't used this up yet. We paid it in advance. So if you've got your notes printed or your book handy, you may be looking at that chart of accounts. That is a handy way to figure out some of the potential account names. So you may have been tempted to call this rent expense, and that would certainly, in a normal circumstance, be what we would use as rent expense. However, we haven't used this rent up yet. In fact, I prepaid it. I paid it in advance. So this is what we call a prepaid expense, which is actually an asset. Remember, an asset is a resource with an expected future benefit. I'm expecting to use this building for the next 3 months. That is certainly a benefit to me. So that goes down as an asset. So we have prepaid rent as our asset, or prepaid rent expense, and then we have cash. Now, since we spent cash, cash is an asset. Assets have a normal debit balance, but I need to make this asset go down, so I want to credit cash, and I want to debit the asset prepaid rent because I'm now expecting to receive rent, the benefit of for 3 months, which is worth $1,200. Now, what we're going to see in the next chapter, in chapter 4, is as time goes by and we have less and less months of rent prepaid, as I've used up some of that, I'm going to go in and adjust this asset account to decrease it to show how much I've used up. So let's look at another one. We're told that we purchased computer supplies from Vision Company on account. And remember, anytime we see the words on account, that could mean accounts receivable or accounts payable. So we have to kind of think about it and think what makes sense in this example. Well, in this case, since I was purchasing supplies, I'm going to have to pay for them later on. So that would be accounts payable. Anytime I'm going to have to pay for something later, it's accounts payable. Accounts payable is a liability. Liabilities have a normal credit balance. So since I have more debt now than I did before, I want to credit accounts payable, and therefore I would debit computer supplies. Computer supplies is an asset. Assets have a normal debit balance. I have more supplies now than I did before, so I want to increase the asset account. So I've debited computer supplies, and I've credited accounts payable, and notice that indent there. And again, it was for $600. So here we're told we completed a graphic design project for a client and we collected $3,000. Now, again, I'm going to keep writing aid reveille up here at the top so we keep remembering it. So when we remember, we're a graphic design company. So when we complete a graphic design project, that sounds like work. And anytime we've done work for a customer, remember, we automatically call that revenue. And revenues are always, 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 always credited. So we want to credit that revenue account. I believe it was called graphic design fees, and therefore we would want to debit cash. Cash is an asset. We have more cash now than we did before, so I want to debit cash and credit graphic design fees. Again, don't forget as you're writing these in your notes to make sure that you're indenting there. It's very easy to forget that, and I want you to get into that habit of making sure that you indent those credits. So here we're told we paid the office salaries of $650. So if I'm looking at that chart of accounts, remember I had that office supplies, office salary expense account. So anytime I pay office salaries, goodness, that's an expense. Remember, expenses are always, 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 always debited. So I want to debit office salaries expense. And then obviously I paid them with cash. So I want to credit cash to decrease that asset account. So I've debited my expense and I've credited my cash account. So here I got an advertising bill, but I'm not paid it yet. I'm going to pay it, but I haven't paid it yet. But I do have the bill and I know that I owe this amount. So I owe this, therefore I have a liability. Remember, aid readily, liabilities have a normal credit balance, so I want to credit that liability of accounts payable. And therefore I would want to debit probably advertising expense. Remember, expenses are always debited. So I want to debit advertising expense to show that this is a resource that I've used up. And then I'm going to credit the liability to show, hey, I'm going to pay this later, probably next month. I'll probably pay it in June. Here I'm told that Rob Sinclair wrote a check on the bank account to pay his home mortgage. All right, first of all, let's just pause a minute. This is not technically illegal, but bad business practice, okay? You really want to keep your personal finances and your business finances completely separate. So if Rob Sinclair wanted to withdraw some money on his account, from his capital account, because obviously he's the owner and he can make that decision and do that, then he could use that money for anything that he wanted. But it is bad business form to just write a check from your business account to pay for your mortgage. But apparently Rob's accountant hasn't told him that yet. I'm sure Rob's accountant will tell him that. But right now, Rob has withdrawn some money from his personal capital account to pay his personal expenses. So clearly we need to credit cash, right? Now, it might be tempting here to say, well, then we want to debit capital to take that out, except we don't actually debit capital. Remember, we talked about that we only credit capital. When an owner withdraws money from their personal account, we would debit that drawing account, right? Or if you prefer the AW reveille, you could call it withdrawals. All reveille, aid reveille, same thing, whether you prefer drawing or withdrawals. Remember, that account has a normal debit balance and that represents how much money he has withdrawn. So we're going to show the capital account and then we're going to show the withdrawal account. And then remember, and we'll look at this again at the end of the chapter, we'll end up taking that withdrawal out of the capital account. So we'll see this again in a minute. So we're going to debit the withdrawals account and we'll credit cash. Now again, ultimately this withdrawal is going to come out of capital, but we don't debit capital directly. We're going to end up debiting capital, but it's going to be kind of a roundabout way that we'll see later on. All right, so here we're told that we sent a bill to Merlin Company, who is a customer of ours, for a large graphic design project. So we've done some work. We did a graphic design project for this company. We've sent them a bill. They haven't paid us cash yet, but we are expecting to receive cash from them because we did the work without having cash up front. Obviously, if we weren't sure if they were going to pay us, we'd be like, I'm going to need you to pay me up front, right? So we did work. We did a graphic design project. So remember, anytime we do work, that's called revenue, and revenues are always credited. So I want to credit that revenue account, graphic design fees. Now this time I did not get cash yet, but I am expecting to receive cash in the future. And so that would be called an account receivable, right? Accounts receivable is an asset. It represents the amount of cash that we're expecting to collect from customers. Collecting cash from customers is an expected future benefit, so that meets the definition of an asset. So another way that this question will commonly read is it may say something like, we completed a large graphic design project for Merlin Company on account $5,000. So again, that phrase on account is commonly used for both accounts payable and accounts receivable. We have to think about who we are in the transaction. Are we the seller? Are we recording revenue? Then it's accounts receivable. If we are purchasing something, if we're buying and it's something we're going to have to pay for later, then it's accounts payable. So here we're told again we paid office salaries for $650. So I hope that you're pausing the video. You're going to go try to do that one on your own. And then you're going to come back and check. And you'll see that just like we did before, we're going to debit that office salaries expense and we're going to credit cash. Now I want to point out in the diagram, notice that we moved to a new page in the journal. We moved to page 2 of the journal. So we restated the month here. So usually you put the month at the top of the page. And then you just put the date all the way down, unless obviously the month changes in the middle of the page. But then when we start a new page in the journal, we'll re-put the month and then just put the date all the way down. All right, so here we're told that we paid half of what we owe on the computer equipment. So remember back on May 1st when we bought that computer equipment, if you want to flip back in your notes, we debited computer equipment for $6,000. We credited cash for $1,000 because that was what the money that we put down at the time we bought the computer equipment. And then we credited accounts payable for $2,500. Now here, or excuse me, for $5,000, pardon me. Now here we're told that we've gotten the bill from Giga Company and we've written them a check for $2,500. So we've paid half of what we owed them. So first of all, I originally credited accounts payable, so now I need to reduce that liability. I have paid part of what I owe them, certainly not all, but part. So liabilities have a normal credit balance. I want to reduce my liability because I owe them less money now, so I want to debit accounts payable. And then I'll credit cash because that's what I paid them with, right? And cash is decreased with a credit. So by debiting accounts payable, we are reducing the amount that we owe on this liability. And then the last one we're going to look at is we received and paid the telephone bill of $220. So I went ahead and paid it. Remember, whenever we see paid, that usually means we need to credit cash. We need to reduce our cash account. And then my debit would be to an expense account, right? Remember, we always debit expense accounts. So I'm going to review that chart of accounts, find the expense account that sounds most like a telephone bill, and that would probably be telephone expense. So I'm going to debit telephone expense and credit cash for $220.